question 35 of chapter 3. Allen Company acquired 100% of Bradford Company's voting stock on January 1st of 2014 by issuing 10,000 shares of its $10 par value common stock, having a fair value of $14 per share. Okay, so this sentence tells us that Allen Company is the parent company, Bradford Company is a subsidiary, and the total consideration transferred. The fair value of the total consideration transferred equals to 10,000 shares times $14 market value per share. That would be $140,000. As of that date, Bradford had stockholders' equity totaling $105,000. So this tells us what is the total book value acquired by Allen Company. Alright, land showed on Bradford's accounting records was undervalued by $10,000. Equipment was undervalued by $5,000. A secret formula developed by Bradford was appraised as $20,000. Okay, so those are the three accounts that have a different fair value than book value, and that's related to the allocation, how we allocate fair value of the subsidiary. Following are the separate financial statements for the two companies for the year ending December 31st of 2018. Okay, so acquisition happened at the beginning of 2014. Now it's 2018, so that means 5 years has passed. And there were no intra-entity payables on that date. Credit balance are indicated by parentheses. Okay, so this is the two companies' financial data, and there are two questions. First, explain how Allen derived the $66,000 balance in the subsidiary earnings account. Okay, question is how they get the subsidiary earnings. Well, this account also means what is the investment income from the subsidiary, or what is the investment income from Bradford Company. So the balance here is $66,000. As we discussed before, Allen Company could use three different methods related to its investment account. If Allen Company used initial value method, then the investment income or the subsidiary earnings here should equal to the dividend declared by Bradford. It is $40,000. So the two numbers are different, which means that the subsidiary earnings, the Allen Company are not using initial value method. Well, if the Allen Company using partial equity method, then the subsidiary earnings should equal to the reported net income of Bradford Company, which should be $68,000. Well, you see that it's still different from the current subsidiary earnings, which means that Allen Company is not using partial equity method, which means that there's only one left. It is equity method. Okay, so I'm going to use the next video to show you how Allen derived this $66,000 in subsidiary earnings, and also give you the consolidated entries at the end of 2018. Okay, to solve this question, let's start with the step 1. Prepare the allocation schedule of subsidiary fair value. The consideration paid by the subsidiary company is $140,000. It equals to the 10,000 share of the stock times $14 per share market value. Next, the book value acquired by the parent company is $105,000. It is the subsidiary company stockholders' equity totaling amount. Next, excess of consideration over book value equals to the difference between 140,000 and 105,000. It is 35,000. Then next, let's allocate the excess amount to those accounts with different fair value from book value. Allocation of excess to accounts. The first account is land. Land is undervalued by 10,000. The second account is equipment. It is undervalued by 5,000. And the last one is a secret formula, which is not recorded but has a market value of 20,000. Okay, so next let's complete this schedule with the excess annual amortization, which means that we need to know the remaining life of those assets. So do not depreciate land. Equipment has 5-year remaining life, and the formula has estimated 20 years of life. And then next, assume they are using straight line method to depreciate their assets. So the annual amortization would be 1,000 for equipment and 1,000 for the formula. In total, that is $2,000 amortization per year for the undervalued asset. Okay, so this is the complete schedule for step 1. Then let's move on to prepare the consolidation entries. Because we know that we haven't figured out what method they are using, and so as in the discussion of prior video, we know that Allen company must not using partial equity or initial value method, which means that they must are using equity method. If they are using equity method, then which means that we do not need to prepare the entry star C. And question A asks how they get the balance of subsidiary earnings. So this subsidiary earnings account is also equals to the investment from subsidiary. And because it's using equity method, then this investment from subsidiary should equals to subsidiary company's reported net income and minus this $2,000 excess annual amortization equals to 66,000. So that's how 66,000 is derived by Allen company. Alright, then for question B. Question B required to prepare a worksheet to consolidate the financial information for these two companies. Well, instead of prepare that worksheet, let's just complete the consolidation entries. For equity method, there are 5 typical entries, that is entry S, entry A, entry I, entry D, and entry E. So entry S is to eliminate the subsidiary company's equity account, which means that we want to use entry A to eliminate the common stock, additional paid-in capital, and the beginning retained earnings. Alright, so since they right now have a credit balance, then we debit these three accounts. We debit common stock, additional paid-in capital, and retained earnings. That's 1118 of the Bradford. And the balance here is 60,000 of common stock, 5,000 of additional paid-in capital, and 98,000 of retained earnings. And then we credit investment in Bradford. So the total is 163,000. Okay, next entry is entry A. Entry A is to adjust the subsidiary company's asset and liability account to its fair value, which means that we need to consider these three accounts in that entry. And the entry would be debit land, equipment, and formula. And for land, the adjustment would be 10,000 because we do not depreciate land over time. And the balance for the amount for equipment now is going to be 1,000. The reason is that after 4 years depreciation from 2014 to the end of 2017, that's 4-year depreciation. And then at the beginning of the year, the undervalued amount is going to be only 1,000 left. Well, for the formulas, that's still going to be 20,000. So 20,000 here. Sorry, no. We still need to consider depreciation for formula. That would be 16,000 equal to 20,000 at the beginning and minus 4-year amortization. Alright, so that's the amount for formula, and then we credit investment. Right, for then that is 27,000. Okay, so that's entry A. Entry I is to eliminate the investment income or the inter-entity income from the subsidiary company, and we debit income from Bradford and credit investment in Bradford. And the amount here is this amount, 66,000. 66,000. The next one is entry D is to eliminate inter-entity dividend payment, and then we debit investment in B and credit dividend from B. That is 40,000. How we get 40,000? So come back to the financial data. We know that Bradford declared and paid 40,000 dividend. So we need to eliminate this one as well. And the last one is entry E. Entry E is to recognize the annual excess amortization. And here we have depreciation related to the equipment, and then there's amortization for the formula. Okay, so debit depreciation expense, $1,000, amortization expense 1,000, and then credit equipment, and then credit formula 1,000. Okay, so after the consolidation entries are prepared, and we can just transfer information from here to the worksheet and complete question B.